IHS, advancing decisions that advance the world.
From the start of June till mid-August, the share prices of the top defence companies in the US and Europe fell faster than the stock markets of the Nasdaq and the FTSE. Now, this, of course, reflects in part some wider economic uncertainty. In the US, at the start of August, Standard & Poor's downgraded the US credit rating, and of course in Europe, there's uncertainty about the euro currency, but also about national deficits. But the faster falls did, of course, reflect specific factors in the defence sector. Defence stocks appear to have fallen faster because of investor reaction to smaller defence budgets and the concern that there will be a lesser spend on defence equipment. And this in turn has led to uncertainty about the kind of revenues that defence primes will come up with. By contrast to the falling share prices of the top US and European primes, the credit ratings have stayed almost universally strong. This is because the business community sees these kinds of businesses as good in the long term because of the kinds of contracts they win, but also because these companies generally produce more cash than companies in other sectors. There are three courses of action that defence primes are generally taking to cope with these falling share prices and also wider economic turmoil. These are restructuring, selling off businesses, and also share repurchasing. Now, there are mixed views about whether there will be more or less share repurchasing, simply because a company might want to keep hold of the cash and stick to the old adage that cash is king. On the other hand, defence companies may wish to use the cash they've got to buy shares at a lower price than usual. When it comes to restructuring, Rheinmetall said it will reconsider its two-pillar strategy and it might separate its automotive and defence businesses. ITT in the US has already separated into three different businesses, and L3 has spun off its government services business. And of course, earlier this year, Northrop Grumman spun off its shipbuilding interests after 12 years in the sector. And lastly, BAE Systems and Lockheed Martin have pursued slightly less radical strategies, and they've spun off certain subsidiaries. So in summary, defence stocks seem to have fallen faster because of short-term investor concern about defence budgets. When it comes to credit ratings, it looks like the credit ratings of the primes will stay pretty much stable for the time being. And then when it comes to the kind of things that companies might do to cope with these situations, the wider economic turmoil and also falling share prices, it looks like companies might pursue more share buybacks and might pursue restructuring in particular.
IHS, advancing decisions that advance the world.